Sometimes you hear about this stuff, on the business pages. You don't hear about it. People don't talk about it much, but it's interesting. So we know, particularly after this week with the big move in the U.S., where the rate was just dropped dramatically in terms of their treasury rate, their treasury rates. What that means to say is they have bonds in the States too. They had a big fall off. And that translates into lower mortgage rates in the U.S. pretty quickly, by the way. And the explosive change from the Federal Reserve, the U.S. Federal Reserve, where the chairman, Jerome Powell, said, yeah, no, hikes are finished. No more rate increases. It's going to go down 3 cuts next year. It just changed the whole complexion of the market. But we've been watching this in Canada. Our bond traders of the Canadian government bonds, which drive all the fixed mortgage rates in Canada, that's where we get all these fixed mortgage rates from, is Canadian government bond trading. Okay, that's where they come from. And the bond yields in Canada have been dropping steadily for weeks now, maybe 8 weeks. And from the all-time, well, not all-time, but certainly from the most recent 20-year peak, and they fell even more. I mean, they're just constantly falling. But, mortgage rates aren't falling that fast. Fixed mortgage rates. I'm not talking about variable, prime, HELOC, any of that stuff. That's going to be much later, but I'm talking about fixed rates. They're coming down, but they're not coming down as fast as the bond yields are falling. So why aren't rates coming down at the same speed as the bond yields? What's going on? And I know what most people say. Damn banks making extra money. They're out to screw us. Okay. Well, banks are in business of making money, but let's break it down more intelligently, okay? Because, by the way, banks also compete like hell for your business on mortgages, but just not every single week do they compete. So let's break it down. What's going on? So first of all, banks are worried. All the big Canadian banks are worried, not about staying in business. I mean, they control the whole country, right? They do 85% of all financial transactions in Canada are touched in some way by the big 6 banks. That's pretty big number, right? I mean, they got a good thing going here. So not about staying in business, just about doing less business and making lower profits. That's what they think about. So when they think, because there's going to be some loan losses. I mean, the banks are betting the economy is not going to do well. For sure they are. Absolutely they are. They would be laying off all these people if they thought everything was going good. So they want higher profit margins. So yeah, they want a little bit more spread. That's what you call the difference between the sort of the bond yields between the cost of funds and what you lend the money out with. That's called the spread. And they want a little bit more juice there because, they're not going to have as good a year. There is a bunch of seasonality to this. Seasonality. So we're in the middle of winter, dead of winter, Christmas almost here, cold as hell, going to be colder. Nobody's buying houses right now. This is just the seasonality of the housing market. And that will change. Come February, that will change, and there will be some kind of a spring market. How good it's going to be, we don't know. How bad it's going to be, we don't know. But there's seasonality to it. So the banks, they want to be involved in that purchase time because they know that's their ideal customer. Their ideal customer is somebody who has a checking account and a mortgage with the bank. That's their perfect customer. That's their most loyal customer. That's their key customer. So they want to have the lowest rates ready to go when February hits and the market comes together. There's a bunch of other little technical things like swap costs are a little high right now. Cost of funds on short term is pretty high right now. And cost of funds on short term comes down more slowly, much more slowly, because that's sort of term deposits and they have got to adjust those down. They got to watch each other as they drop it. I know this sounded like complicated bullshit. I get it. Okay. So rates aren't falling as fast as they could be. You're right. Is it the banks trying to gouge? Some would say yes. Some would say it's just the way they position themselves for a much, much more aggressive market starting in February and March, when they go at each other like gangbusters, like they just attack each other in terms of better rates, more cash incentive. That's the time where they really get busy. So is it not really reflective of how fast bond yields have fallen? It's not. Bank mortgage rates are not completely reflective. But you give us till the end of February, and the fight will be on. The rates will come down, and they'll be lower than today. There'll be a lot of rates in the fours coming up in February. That's my thought.